Thanks for coming back to the latest episode of the Credit Clubhouse. We are your one-stop shop for all things credit. Before we jump into our next episode, we have an exclusive offer for our listeners. If you're interested in attending any of our conferences throughout the year, we have a great deal for you. Just head to www.DealCatalyst.io, pick the event you want to attend, and enter the promo code CREDIT at checkout. This will give you 10% off any ticket to any conference. As always, don't forget to follow the show, rate us, and leave a review. We encourage your feedback. It'll help us make these episodes a better listen for you. And now, on to our next episode. Welcome back to our latest episode of the Credit Clubhouse. As always, I'm your host, Todd Anderson, head of content and programming at DealCatalyst. Joining me today is someone who probably needs no introduction to at least the DealCatalyst audience, and that is Owen Sanderson, the ABS editor at 9fin. Owen, thanks for joining me. How are you doing?
I'm doing great. Thanks, Todd. Thanks for having me on. It's always a pleasure to work with DealCatalyst. I love moderating your stuff. I love attending your conferences. Honored to be here.
Great. So, I think having you on, is a unique perspective. Given you cover a lot of different areas of the credit markets, and you're not necessarily a particular participant coming from one perspective. I think you can bring a pretty varied perspective to this conversation. So I think just starting off maybe a little bit high level, kind of what are you seeing as some of the hottest areas in the credit markets today?
Okay, so I think the big theme, we're not going to do geopolitics today, but the big theme in credit is absolutely insurance capital and the evolving dynamics that we're seeing with the insurers that are owned by the big asset managers, some changes to insurance regulation. Like the big question in credit structuring generally across private credit, across asset-based finance is like, how can we get assets to insurers? How can we make things suit our insurance capital? And how can we deploy the insurance capital that's kind of coming into these markets? So that's what we want to talk about today.
So maybe set the scene in terms of some of what you're seeing in the market. In terms of are there particular areas that insurance capital is trying to gain access to, whether it be ABF, fund finance? I mean, kind of where are some of these pockets where you see insurance company coming in big waves? Is it just across the board? Is there kind of, particular areas of the market where you see it more than not? And is it kind of leaning into maybe some of the structures that are out there?
Maybe we do some kind of history first, or at
Sure.
least, so the pioneer of this whole flywheel, I think they call it a flywheel, between insurance and the alternative asset management industry was Apollo with Athene. This kind of well-known history, and you can, dial into CNBC and see Mark Rowan talking about it, most days of the week. But basically, the idea was if you take an insurer, then you can provide a permanent capital source for originating all kinds of assets that alternative asset managers do. So you mentioned fund finance, and the smaller pockets, I think we'll dig into that later, but we're talking basically the whole spectrum of credit. This is benefit for the insurer. The trade is basically insurers back in the day, whenever that was, had portfolios of corporate bonds, investment grade corporate bonds, generally pretty low yielding. You turn that portfolio over to private assets. Some of the things we'll talk about later on. The insurer gets better returns, and the asset manager gets permanent source of capital. And this model has been kind of replicated by every big player in alternative asset management. The big beasts, the KKRs, Carlyle, Brookfield, Blackstone, slightly different model, but broadly similar. If you look at Blackstone's divisional setup, you've got it's Blackstone Credit and Insurance. That is the group that they now run most of their kind of private credit, asset-based finance and infrastructure activities through. It's not an accident that insurance piece is in there. So to kind of take that forward, I guess my answer to where are the pockets is kind of the pocket is everywhere. The pocket is everywhere in credit. But asset-based finance, I suppose, particularly important. I was just before our call today, I was going through some of the like reporting that KKR was doing. Their last investor update, they described their partnership with Global Atlantic as a step function change in what our credit business can be. So Global Atlantic is now doubling the amount of origination volume it was before KKR owned it. So they used to be writing about 17 billion, I think, annuities per year. Now they're doing 36 billion. So think of that in terms of private credit fundraising, right? You'd have seen the kind of headlines that come through, Ares or whoever has raised a 20 billion fund.
Yep.
Maybe which will be, world historically huge. Just think about kind of almost double that kind of every year coming straight through the insurance arm. That's, put this in context, compare it to the sort of closed-end and fundraising activity you see press releases about, and you kind of see how huge this insurance piece is.
I mean, is that the ultimate goal of any, of these funds, is buy an insurer eventually, get a permanent source of capital? And on the flip side of that, I mean, are there downsides to it? I mean, what are some of the risks? Is it just, too much, too much capital with too few firms? I think there's 15 or 20 that have bought an insurance company. Is that number larger today? I mean, what's the total number of asset managers that own an insurance company, and maybe what are some of the risks that are involved in this?
I don't have the total numbers. There were some kind of regulatory reports on this. One at the end of 2023 from the IMF. Actually, there is room to grow. I think it said that about 10-12% of US life insurance assets are kind of held in these private equity owned insurers. They call them private equity owned. I think that's a misnomer because it's not the real private equity stuff that's going into these insurers. It's the credit arms of the alternative asset managers. But, whatever, we'll give the IMF a pass in this one. That's fine. You don't have to just think about insurance necessarily. So an interesting trade that Sixth Street put on. Sixth Street bought it's mostly a funeral plan provider in the Netherlands. It's called Lifetree. They bought it at the end of last year, I think. And if you think about a funeral plan, it's a similar kind of arrangement to life insurance. You're making savings throughout a customer's life, and you have a mortality linked payout event, and therefore you have long-term permanent capital that you can deploy into private credit. That's a smaller segment than life insurance, but you can think outside the box. If for the firms, this probably only works for firms at a certain scale. So I think most of the big guys have probably already found their partnerships. Those big institutions are probably going to be rolling up any smaller life insurers that become available in an M&A process. If you don't have scale, you cannot put on this kind of symbiotic flywheel type trade because you need to own a meaningfully sized insurer. And I think what we're going to see is the big guys getting bigger and becoming more dominant in this area.
And what is that? The risk part. What does that bring up in risks?
We've got to talk about the risks.
Yeah.
So far, it's a happy story. I think there was a life insurer that fell over in Europe in 2023, but that was more of a PE style investment, and the sponsor just didn't want to put in the capital required. But I think there's some complexity around conflicts of interest and who benefits at what time. It's a big alternative asset manager is a kind of complex beast with different funds, different LPs and different funds, and obviously the insurer itself, which has its own board and manages assets in a certain way. So if you kind of have portfolios of whatever, a mortgage portfolio going in, and what you're doing is kind of tranching that up, and the insurer takes investment grade piece, and some kind of mid-return fund is taking the mares, and the total return is taking the equity. That's fine. You can manage that, but like that's you kind of shouldn't be on all sides of the table at once, or you've got to carefully manage how you're on all sides of the table at once. Do you make this deal a kind of debt friendly or equity friendly thing? Or if you're the debt and the equity, you could say it doesn't matter, but actually you do have subtly different interests around different parts of that. I think we kind of haven't seen that play through a full credit cycle to kind of see how those situations manage themselves when the chips are down a little bit. Like asset-based finance right now, conditions are pretty good. And by design, senior tranches are generally fairly safe, but things do go wrong. Accidents happen, conditions change. So I think that conflict piece will emerge at some stage.
What about the idea of, the bigger are clearly getting bigger, taking bigger shares of the market. Bigger funds are starting to buy smaller funds. I mean, ultimately, down the road, can you see it being an issue where they own and originate so much that it kind of crowds out the market, and then also begins to play around on price, and essentially they drive so much that they're able to own price, drive the conversation where they want it to go, and essentially things get skewed so much towards the big funds that the smaller funds are not able to participate in the market to the way that they used to, and B, pricing is just so skewed towards where they want it to be, it brings a different risk into the market. I mean, are we heading in that direction?
100%. I think I'm not sure whether this is the explicit goal on earnings calls, but it's definitely the explicit goal behind closed doors. No, nobody in markets wants to be a price taker. Everyone wants to be a price maker. And you kind of, the scale that some of these bigger institutions can deploy can make them essentially the only game in town. Again, I'd point to Apollo. I mean, not to pick on them, this is admiring what they're doing in certain respects, but some of the huge investment grade trades that they've put on, if a large company, I don't know, they did the trade, I think the chip fabrication plant with Intel, I think it was 11 billion or something. If you want to go get a 10 billion plus check from one institution for a complex thing, move quick, like there just aren't that many players. You will be talking to Apollo, and Apollo will be saying, yeah, we can do it. The price is this. That's a good place for them to be in, for sure. I guess by definition, if all of the other big guys get to that place too, then you can talk to 5 different institutions and you don't get to be price maker anymore. But still, it's nice. Even still, it's nice to be out there, kind of where the air is clear and the competition is limited. So yeah, I think they're definitely trying to use scale to drive their own pricing, and for borrowers with a particular set of requirements, these guys are going to be the only game in town. I think more generally, I think of it like where the investment banks were pre-2007. So, that was before I started covering markets, but I've read some of the history and studied this to some degree. An investment bank pre-2007 was, taking big principal swings, like doing a lot of prop trading, seeding hedge funds, trading commodities. Like they were active risk taking. They were owning mortgage originators. They were owning the whole life cycle of asset-based finance, basically, to kind of feed this asset engine. And then now they're kind of shrunken versions of their former selves. The liquid trading is done by Citadel and Jane Street. The kind of credit, the hard yards in credit are being done by Apollo and Blackstone, KKR. So they're kind of, the goal, I think, for these big guys is to be a sort of full service financial services end-to-end ecosystem like a pre-2007 investment bank, but hopefully safer.
Hopefully safer. I mean, what about the dynamic that, of the non-captive insurers? You have these 15, 20, whatever that number is of captive insurers. How has that impacted the non-captive insurers, putting more money into, private credit, gaining access to some of these assets through these different structures? I mean, how has the dynamic changed between those that are owned by PE shops and the big funds and those that aren't? I mean, is the the power only with the Apollo big KKRs of the world, or how much power does the other insurers own today, so to speak?
I think there are very, very different models in kind of insurance, and I don't think any of the large insurers are kind of blind to the opportunities in private credit and asset-based finance. They're just choosing to work through that in a different way. They'll be fund LPs, or they'll own a CLO manager, or they'll have like bits and pieces, or they'll have long-term kind of not just one LP in one fund when that's being raised, but they'll say, okay, we're going to do your next 5 funds to a certain private credit manager. So they're still kind of in that ecosystem. They're just not tied in quite the same way. They're making arm's length commercial arrangements. There was a firm that did media related stuff. I forget the name, but they were doing some quite innovative like film financing type things, like intellectual property, financing the slate of films, and they're funded by MassMutual, which funds a bunch of other managers. Like they buy a lot of regular bonds too, but you can they're where the money is. Clearly managers that are outside the kind of ecosystems of the Apollos of this world will be going to where the money is, and absolutely they're deploying into the space.
We mentioned hopefully it's safer. I mean, how does the regulatory aspect come into play here? Obviously the regulators are not blind to what's been going on, or at least you would hope they aren't blind to what's been going on. I mean, I know the NAIC has certain requirements and risk-based capital rules, and I'm sure there's European counterparts have similar type rules. I mean, how do you think insurers are kind of handling what this trend has become, and where does the regulatory piece fit into this puzzle?
So the NAIC rules, as I understand them, place quite a heavy weight on ratings. Like they're not completely ratings driven. They can be reviewed, but your sort of initial point of entry to any kind of NAIC capital world is a rating, can be public, can be private, but it's a credit rating kind of universe we're talking. Does that guarantee safety? I mean, it didn't in 2007. The rating agencies are subject to very different kind of regulatory models. I think it's probably best to view that as a sort of approximation of what the credit quality is, rather than necessarily the final answer. But I think you can take some comfort from liability structures here, like this. To compare to 2007, you had liability structures there that were very short term. You were borrowing very short on an unguaranteed, continuously rolling 30-day basis to go buy bonds that were, could be extended out to like 30 years. That is an inherently unstable and dangerous model. This is kind of flipping it. A life insurer, the asset portfolio is almost certainly much lower duration than the liability portfolio. Like you don't have the kind of run, you cannot have a run on a life insurer in the same way. that kind of drives one of the key manufacturing considerations for insurers, which is how do you create duration out of some of these asset classes, which maybe we can touch on later. But it genuinely is more stable in that respect. So I'm less kind of concerned about that. Is a certain asset a single A because you managed to jam it past the rating agencies when it's actually a triple B? I don't know. That's kind of fine if it's there or thereabouts. Um, the environment in Europe is very different and much more stringent, particularly with respect to kind of asset-based finance and securitized products. It doesn't have the same rating universe. You have a thing called Solvency II, which places a great premium on predictable kind of guaranteed cash flows. So something that is a portfolio of consumer credit where people pay back loans in a slightly unpredictable way, that works very poorly under Solvency II constructions. There are structuring ways that you can kind of thread the needle. It's a bit painful, and in general, European insurers are sort of massively underallocated to asset-based product.
So, let's dig into maybe a few different areas of the market in terms of, either ABF, fund finance, whatever, is kind of where you're seeing, some of these interesting structures, come about. And, maybe dig into kind of what are some of the structures and what are some of, these platforms, what are they doing to gain more insurance capital? Are they, is everything becoming sliced and diced and tranched and, becoming insurance friendly? Are there other structures that are, kind of coming to market that are interesting and innovative that is appealing to the insurers? I mean, maybe dig into a little bit more of the specifics about, where the asset class might be, but what are some of the specific structures that are kind of getting, things a bit more appealing to the insurance investor?
So the things you need to manufacture a good insurance product are investment grade, as we talked about, and ARC very kind of ratings driven, but investment grade helps, wherever you are in the world. And ideally, you need duration, particularly if you're going into life insurance rather than P&C. You need to manufacture that duration from somewhere. So yeah, you're slicing and dicing, and when you have portfolios, we've been dancing around fund finance a little while, so let's talk about that. If you have subscription line portfolios, subscription lines are super short term. Like they're, it's a revolving credit facility. So it's a credit card for a fund, basically, to simplify. So how do you package those in a way that makes them long enough and yieldy enough to kind of work for insurers? There's securitization technology to do this. There's been one kind of rated public deal, which essentially adapts the sort of master trust technology that you can see that's commonly used in credit cards, like consumer credit cards. You use it for the fund credit card, basically. You're putting facilities in and out. You're like trusting essentially the manager or sponsor of the deal to kind of rotate assets in with the right eligibility criteria to keep the sort of portfolio to its right conditions. To you've pre-baked this in the docs and someone's got to fill it in. And I explained that quite poorly, but that's the kind of idea. You can take a short thing and make it long if you want to, using this technology. So that's one example. I guess other routes are start with something that's already pretty long. So reverse mortgages or equity release, as we call them this side of the pond. That's been a huge trade for the UK life insurance sector. It's not subject to quite the same dynamics of being owned by the alternative asset managers, but the vast majority of all of that product that's written in the UK is owned by UK life insurers. And that they're structured internally as securitizations to thread this needle that I talked about with the predictable cash flows. But if you start with something that's already 30 years long and you get all of the cash flows at the end, you've got duration in spades, and you just got to figure out what to do with it.
Is there a concern that, the more they manufacture and slice and dice, that, the quality of whatever the asset might be kind of begins to deteriorate, only because the volume of money we were talking about earlier? I mean, if there's endless billions of dollars, is there enough supply on the other side to fulfill this at the levels in terms of quality that is needed, especially for the insurer? Or are they manufacturing some of this to make it, quality enough? And is that bringing risk into the system that maybe is not as obviously seen today, but a few years from now, we're like, holy crap, look at all this that is held by insurers, and the quality is down. I mean, it felt like 2007, 2008 at the time came out of nowhere, but clearly there was a run up to that. And maybe, the blinders were on because people were making money and there were fees being driven. And do we risk some of that today? The more that needs to be manufactured or sliced and diced for insurers, eventually the supply is not as good, so they begin to go down the spectrum and kind of manufacture that up the spectrum.
I think that's a very fair concern. And yeah, once you get to a point where, if we just talk about consumer credit, if credit is not driven by consumer demand, but like being pushed by the wall of money trying to invest into that space, then yeah, you get loosening in terms. Obviously, there's consumer credit is regulated in most areas, and you can only loosen terms so much. But yeah, like supply and demand will do what it does, and people will try and foist products on borrowers that don't need them, or give them terms that are not compatible with their ability to repay. I can totally see that, how that risk would get there. I don't think we're there yet. There's this like famous last words, you never want to be that guy, but I don't think that.
And do you is that risk even remotely possible on the corporate credit side? I mean, or is it more that, the big guys just own so much of the pricing that you have companies that essentially have no wiggle room or negotiation? They have to agree to things, and just what they're agreeing to, they're unable to fulfill. They got their money, but ultimately they can't pay it back, or they can't, stick to the terms where they, acquired that capital. And you just have a lot of companies that are just overweight with debt that they really can't afford, or they can't afford, with the price and terms, because the negotiating power from the big shops is just too much.
I would say areas of possible risk or kind of over exuberance might be like newer forms of contractual cash flows. I mean, I'm less familiar with, markets like royalty finance, litigation finance, pharma settlement, music, IP. Yeah, sorry. All of these kind of things, they're not necessarily new. Like, we've always had song rights since, Elvis was robbed, but like the streaming thing is pretty new. Is that like a stable thing? Probably, maybe. Does Spotify exist in 10 years in the same form that now? I don't know. Does the model, like, we just don't know. We do not have a historical thing like we do for what happens to the housing market in a recession. It's just uncharted territory. And if you kind of draw the lines out from current trends, yeah, looks great trade, guys, but like, we just don't know. Data centers, I'd put in the same category as that, whether you finance them through like an ABS-like structure or more from a commercial real estate approach. Is probably coming from some, private credity, asset-based type of money, whatever the format is. And again, We don't know. The lines are going up and to the right very aggressively, and there's a huge demand for capital in this sector. But does the data center market look the same in 20 years as it is now? Definitely not. Does it look way better? Maybe. Does it crash? Does it burn?
Do we
Possibly.
have a new technology that we're not talking
Yeah,
about today that comes up in 10 years and throws that element out the
yeah,
window? We don't know.
yeah, exactly. Or maybe it'll, I don't know, everyone wants to co-locate with power sources at the moment. We crack cold fusion, and then suddenly all the ones that are located by hydroelectric dams are rubbish or something. It's impossible to predict that stuff, but that's kind of the point. If you're creating long duration cash flows, you're kind of safer doing that of something like the housing market, where you can at least say, look, we back tested this over 30 years, and it kind of looks like that through a couple major recessions and COVID. You can't backtest your data center performance by 30 years. It's just
Yeah.
not possible. There's nothing there. So I guess commercial real estate more generally would be another pocket. I think that again comes into this kind of private credit asset-based universe. Like, people cut it up a little differently, but you still have some of the flows of funds going through commercial real estate debt. I think basically every financial crisis we ever have takes down commercial property with it. It's either caused by commercial property or it takes commercial property down as well. So you can backtest it, and you find it's garbage in every single recession. So the next crash we have, that's probably going to come down to. That's a safe prediction. I'm happy to make that.
I mean, we can wrap up in a few minutes and with some predictions, and then maybe some fun questions out the door. But coming back to kind of our main theme of the day, with the captive insurers, alternative asset manager kind of connection. I mean, what, in your estimation or from your seat, what is most interesting that you think could be coming out of that trend or that symbiotic relationship next? And kind of, where do you just see the continued trend that we're seeing today just continuing to go up and to the right? Where do you see some of this playing out? Is it just the big funds are just buying more smaller funds and they're just acquiring more power and more negotiating ability, so to speak? I mean, where does some of this trend, go over the next few years? Do we just see it continue to kind of where we've seen it?
I think long term, all financial markets kind of, they want to trade, or the people in them want to trade. Like right now, we've seen a big pendulum swing towards private assets of all kinds. You guys have put on some great private asset conferences. We've hired private credit teams.
Well, thank you.
It's the golden age of private credit. Like, it's we know that, and that's fine. But yeah, like every financial market in history has sort of started out as kind of private, brokered, gatekeeper type markets, and then kind of swung into, oh, actually, you can kind of trade this more institutionally, and you can market, and it will go liquid. And so I kind of wonder how that plays out. Like, are we at the end of the pendulum swing into private things, which has been driven by this insurance capital, or do we, what brings the pendulum back? Like, those insurers decide they actually do want to turn their portfolios, and we kind of have to find a way to reliquify private credit. I keep talking about Apollo, but they keep doing interesting stuff. So you probably saw those headlines about Apollo private credit ETF. So Apollo's going to be market making its own private credit loans to kind of form the basis of the ETF, because it sort of doesn't work if you can never trade them. But so that's like one step back on the pendulum. Do you eventually get the pendulum coming all the way back, where the things we thought of as private kind of go through the same process that leverage loans did in like the 90s and early 2000s, where they're like, okay, these were private assets that were stuck on bank balance sheets. and they're basically turning into a thing that's now more or less as liquid as a high yield bond. It's a tradable syndicated asset class. Like you just, and then basically you've just recreated another leverage loan market or something. You kind of, yeah, they, as participants come into this, as institutions that have a lot of assets want to turn their portfolios, I believe we will kind of see that like natural pull to liquidity reassert itself to some extent. Now, does that mean that it's just going to be Apollo kind of crossing positions between its own funds? That would be kind of disappointing. Is it going to be the kind of 5 to 10 big guys trading assets with each other, or is it going to be a kind of full ecosystem where the private once again kind of becomes more public? That's deep crystal ball stuff. I'm not even sure this will happen, but I think, yeah, as most markets have developed, they've gone through this. So I'd be watching for that change to kind of come, the private to once again become public.
Yeah, I mean, that's the ultimate question. I mean, all the drivers have made staying or going private more beneficial today. But you'd have to think eventually the pendulum at least swings somewhat back, because there's always been a healthy balance of public and private. And we've kind of skewed more private, but you would think over time, take 20 or 30 years, there's going to be somewhat of a balance, and it should hopefully balance itself out, but that's not always the case. Or you get more innovations like Apollo and you get other funds creating ETFs, and that's semi-public. So it's kind of like, mixing the two worlds, so to speak. I mean, maybe that's our future, where it's not fully public, but it's kind of the mix of the two worlds.
I guess I said I wasn't going to do politics, and I'm absolutely not. But like the new administration in the United States definitely has a different attitude to securities laws in various respects. One prominent member has had prominent disputes with the SEC over the years. I would expect that the existing constellation of regulations that partly encourage private markets to develop by making being public very expensive and very difficult.
Yeah.
I don't know what that will look like in 4 years, but I'm pretty sure it'll look different. And different in the direction of more relaxed about some of the more burdensome aspects of the rules. So, how that shakes out could be a bumpy ride, could be kind of interesting, not doing the politics, but it'll definitely be different, and that is going to have an impact on the public-private debate.
Yeah, and then you have the 50 state regulators that kind of want to, if they see the lax coming from federal government, they're going to want to, at least states that lean one way or another are going to want to either agree and kind of follow suit with those, or they're going to be the opposite and try to, increase the regulatory thing. So it's going to be this balance of like who wins out, where you're located, where the regulator certainly has more power or not in terms of federal. I mean, federal usually wins the day when the two are fighting, but securities laws can be a bit nuanced. So, who knows where that ends up. We have just a few minutes left, so we can end with a couple of lighter questions. Do you have, a favorite sport or hobby?
That would be mountain biking. I like riding bikes fast down hills. I'm not very fast, but I try.
Tell us one surprising thing about yourself.
I used to sell boat tours for a living.
Interesting. Okay. That's a good one.
Around Cambridge, I pushed a boat with a stick. That was my job. Great summer activity. All the girls love a guy with a boat. You got a strong right arm.
What's the most exciting part of your job?
It's it's always talking to people. Journalism is about keeping your ears out and talking to as many people as possible. I'd always rather be out of the office gossiping than kind of sat behind a screen, combing through a PDF or whatever. So it's just getting out there and seeing the people. And when you hear something interesting, something that really kind of unlocks the situation, you run back with it to the office and try and firm it up. That was a great feeling. That's good.
And then final question. We've done a little bit of crystal ball stuff, but give me one prediction for the next 12 months.
Volatile.
That's a pretty good one.
Yeah. I believe in the European defence trade. I think my home continent is going to finally get it together. It's been a while, but I think we're finally going to do it. So yeah, long BAE Systems, long Rolls-Royce, get involved. It's happening.
Well, Owen, I really appreciate your time as always. Good to see you again, and keep up the good work. I'm a constant reader of 9fin. You guys do great work.
Great. Happy to be here. Great session. Thanks a lot, Todd.
Yep. Thank you. Thanks for coming back to the latest episode of the Credit Clubhouse. We are your one-stop shop for all things credit. We have an exclusive offer for our listeners. If you're interested in attending any of our conferences throughout the year, we have a great deal for you. Just head to www.DealCatalyst.io, pick the event you want to attend, and enter the promo code CREDIT at checkout. This will give you 10% off any ticket to any conference. As always, don't forget to follow the show, rate us, and leave a review.